Today, February 4th, 2026, was a wild one in the Asian markets. You really had two completely different stories playing out. We're digging into a new analyst report that calls today a major turning point, and honestly, for good reason. On one hand, you saw a market absolutely shattering records, and on the other, a pretty steep, painful drop. So what on earth was going on? Let's dive right in.
And it all starts with this number right here. Today, South Korea's KOSPI index didn't just inch past its all-time high, it completely smashed it, closing at an incredible 5,371.10. Now, according to the report we're breaking down, this isn't just a great day for traders. It's a huge signal that the entire structure of the Korean market is fundamentally changing.
Because, while Korea was basically popping the champagne, another key market was telling a whole different story. And that's really the heart of what we're looking at today, a real-time tale of two markets, heading in completely opposite directions.
And this slide, wow, it lays out that contrast just perfectly. You can see the KOSP soaring, up over 1.5%. Even mainland China's SSE composite had a pretty solid day. But then you look over at Hong Kong's tech index, the HSTEC tech, and bam, down almost 2%. This is the big puzzle this report is trying to piece together.
So what's really driving this massive split? Well, the report boils it down to these two core ideas. It argues that what's happening in Korea isn't just some flash-in-the-pan rally. It's a structural evolution built on real, solid changes. Meanwhile, Hong Kong's tech slump, that's all about psychological pressure. We're talking global sentiment. We're talking mood. Two totally different forces at work.
All right, let's start with the good news, the Korean side of the story. How in the world did the KSPI climb so high, so fast? The report's explanation goes way beyond just the day's trading data, digging into some seriously powerful economic theories to get to the real why.
The first big idea comes from Nobel laureate Simon Johnson, and it's something called inclusive institutions. Now, the concept is actually pretty simple. For a market to have real, sustainable growth, it needs to have strong, fair, and transparent rules. Rules that make investors feel safe and confident enough to stick around for the long haul. And here's how that fancy theory is actually playing out in the real world. The report points directly to Korea's corporate value-up program and much stronger property rights. It says these reforms are finally getting rid of the old Korea discount, that frustrating tendency for Korean companies to be valued lower than their global peers. And the ultimate proof? Samsung hitting a market cap of 1,000 trillion won. The report literally calls that the market's official stamp of approval.
Okay, the second key idea is something called low time preference from economist Safeddin Amis. It's really just a powerful way of saying that a healthy, robust economy is one where people are focused on long-term investment and building capital, instead of just, short-term spending. Thinking about tomorrow, not just today.
And the report argues we are seeing this play out right now. Investors are betting big on Samsung's long-term future, not just its next quarterly report. We're also seeing a clear shift in money, moving away from more speculative stocks and flowing into the KOSPI's blue chips, those big, stable, powerhouse companies. The report calls this a qualitative improvement, which means the quality of the money in the market is actually getting better. Now here's a really cool concept the report brings in, Gunter Dueck's theory of swarm intelligence. It suggests that sometimes big market players act less like individuals making isolated decisions and more like a collective swarm, like a school of fish or a flock of birds, all sensing a major shift in the environment at the exact same time. And that is precisely how the report explains today's massive 1.81 trillion won net buy from the big institutions. It says this wasn't just a coincidence or a bunch of separate decisions. No, this was the swarm in action, sensing that the Korean market had broken through to a whole new level. And this collective move was so powerful, it completely shrugged off a weaker trend that was coming out of the US market.
Okay, let's switch gears and talk about the other side of this story. Because over in Greater China, the picture was much more divided. The mainland market did okay, it rose. But Hong Kong's tech sector, it really took a hit. And to explain this, the report shifts from economics to psychology.
The core idea here is social mood, from a guy named John L. Casti. He argues that the collective feeling of the public, the general vibe, you could say, can actually predict where the market is going, often shaping the story before the news headlines even catch up.
And today, we saw two totally different moods at play. In mainland China, the market was apparently lifted by a positive feeling about the government's heavy investment in AI. But in Hong Kong, the mood around tech was just plain negative,
completely dominated by fears over global interest rates. This created what the report calls an information cascade, basically a domino effect where a few people start selling out of fear, and it causes everyone else to follow suit.
So does this drop in Hong Kong tech spell disaster? The report says absolutely not. It uses this great metaphor from the investor Ken Fisher, calling it the adjustment waltz. The whole idea is that this isn't a crash, it's just a normal corrective step in the market's ongoing dance, a natural rhythm. So, we've covered the why behind what happened today. Now, this is where it gets really interesting. The report looks to the future. Based on all this analysis, where are these markets headed from here? And it actually lays out some very specific, very bold predictions for the rest of February. And here are the numbers. The outlook is pretty optimistic across the board. The KSPI is forecast to climb another 5+%, and China's SSE composite over 6%. But the really surprising part? Take a look at the H-Tech. The very same index that got hammered today is predicted to have the biggest rebound of them all.
This chart really makes that prediction pop. An over 8% surge forecasted for the Hong Kong Tech Index by the end of this month. The report's logic here is that the current negativity is a massive overreaction, and that's creating a huge opportunity for a sharp bounce back as that social mood swings back toward the middle.
Okay, so theory is great. Forecasts are exciting, but how can an investor actually use this analysis? Well, the report doesn't just stop at theory. It boils everything down into a clear, three-part strategy it cleverly calls the Nobel Quant approach.
So the strategy is built on three main pillars. First, concentrate your capital where the real strength is. Second, use a pretty clever arbitrage technique that links different market movements together. And third, bet on that idea of social mood eventually swinging back to the average.
Let's quickly break that down. Concentration simply means putting a big chunk of the portfolio, about 60%, into those strong KOSPI blue-chip stocks. Arbitrage is about watching the currency market. If the Korean won weakens past a certain point against the dollar, the strategy is to buy KOSPI futures. And finally, mean reversion. That's just a fancy way of saying you systematically buy into those beaten-down Hong Kong tech stocks, positioning yourself to capture that big 8% rebound we just talked about.
So, after all the data, all the theories, and all the strategies, what's the bottom line? What is the one big takeaway from everything that happened in the markets today?
And it is a very bold, very optimistic final thought. The report concludes that with Korea's fundamental strength and Hong Kong's expected rebound, we could be entering what it calls a golden month, a pretty rare window for potentially historic returns.
So the report lays out a really compelling case, connecting deep theory with today's hard numbers to chart a path forward. But of course, it leaves us with the one big question every investor has to ask themselves. In the complex, often chaotic dance of the global markets, is any path ever truly certain? Thanks for joining me for this breakdown.